Welcome to the Alt Asset Allocation Podcast, exploring alternative investment opportunities available to the everyday investor. Here's your host, Ben Lakoff.
Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Peter Harlin. Peter is one of those rare individuals that keeps pretty close tabs on a number of financial assets and markets. In fact, he's my go-to guy for insight into where financial markets could be moving and what sort of things might be worth looking into a little bit more. Macro is complicated, but I always enjoy talking to macro thinkers like Peter to help provide a bit more clarity. Either way, the markets have a tendency to humble investors, but I think that thinking bigger picture, like some of these conversations, can provide tremendous benefits. All right, Peter Harlin on the macro picture of financial markets. Enjoy. Peter, welcome to the Alt Asset Allocation Podcast. Good to see you, sir.
Good to see you, Ben. Always.
Dude, episode 3. So this was August 15th, 2020. So now this is mid-July. So more than 2 years. And honestly, we probably recorded that in June or July of 2020.
Yeah.
So middle of the pandemic, lots of people said very, very good things. So we covered all things macro. And in case people haven't heard that one, let's just do a quick overview, who you are and what you're doing professionally, and then we'll jump right into the markets.
Sure. So I appreciate you having me, Ben. Always, it's good to see you. I have always worked in financial markets at big banks. I've worked at JP Morgan and now Wells Fargo for about a decade. So working with clients, predominantly ultra high net worth clients, just kind of advising and monitoring and working with clients across, all kinds of public and private assets and businesses and really all types of people. So also have a little bit of crypto experience as well with Ben, which has been fun to do as well.
Demonstrate. You're a humble man, but Peter's big shot and deals with a lot of different asset classes and can speak very, very clearly and intelligently across all of these asset classes, which is why I always benefit, and I know my listeners will as well, kind of having you talk through this. So let's jump right into it, man. Mid-July, let's talk about the macro world. There's a lot of fear out there, a lot of chop, a lot of, So crypto markets are down like 70% since their highs. Let's kind of paint me the picture of what's going on macro right now.
Sure. I mean, I think at a macro level, a few things, just notably like fact check or bring facts up to speed. Worst half of a year in equity markets through June since the early 70s. Also within the last half, the first half of this year, we saw the worst quarter for bonds broadly that we'd ever seen. The aggregate bond index down double digits, which is almost unheard of when you see bond prices coming off peak yields. But the big story really to me is a reduction of liquidity in a less easy monetary environment. What's interesting to see, and we can talk about more of these things, is the interplay between central banks and the fact that we're actually in a slightly diverging central bank policy situation. And you're starting to see that play out across currencies, and then throw commodities in the mix there too, which have reawakened. And you've got just such an interesting, it's almost three-dimensional way of thinking about prices, where your base currency, if you want to think about your base as crypto or as gold or as real estate or all these different things, or the euro, or just depending on where you base from, almost shades your view of how things are going in the world and how it's repricing. So it's kind of real time. I think in our last interview, as I recall a couple of years ago, I don't recall a lot of things and I don't want to fact check a lot of it, but I probably should go back and see what I said back then. But I think one of the things we did talk about was sort of how wealth and currencies play into wealth. And I think we're witnessing it right now. With the geopolitical situation, et cetera. So.
Yeah, I remember from all those macro talks in 2020, kept saying like unprecedented time with the monetary actions that were happening. And now we're starting to see kind of the ramifications of a lot of that easy monetary policy. But so right now you deal with a lot of clients positioning their portfolios, like to make those tactical moves now, you kind of have to have a clear picture of where you think the world is going to play out. From where we are now, what are kind of the general themes you're thinking about going forward?
That's a great question. And so I'll just kind of ramble for a bit here and try to stay on track. But broadly, and no offense to anyone else, but it seems to me that the US is still pretty much the strongest player around the world. You look to other comparables down the top five or so, 5 or 7 GDPs around the world, and the US just seems utterly dominant still for a variety of reasons. You look at sort of stability and wealth and ability to navigate, and you have to look at natural resources, you have to look at demographics, you have to look at technological superiority, agriculture. Perfect example is unfortunately Europe right now in a severe situation where they're forced to buy from sort of the most dangerous person or country right across their border there, and basically forced to support their currency, support their economy. Well, we're all trying to do the opposite thing in a way. And so it's a perfect example of how natural resources are currency, and ultimately the base export is what you have as natural resources versus domestic currencies. Domestic currency is more a reflection of that. So, a couple big picture items, obviously the year of inflation, when people sort of have awakened to the thought that inflation can actually occur, a little bit of a view there. Many people think that it's purely, and rightfully so. I mean, no one will know for sure who's right until 5 years from now, probably. But I think a lot of people have moved toward the camp, and certainly a lot of people come out of the woodwork who for the last 12 years have said it's inflation as a result of monetary supply increasing and the expansion of M2, which effectively went from 15 trillion to close to 20 trillion in the matter of really just several months or a year after COVID. But combine that with, we had a massive supply shock that we haven't seen. I mean, it was a war-like supply shock to supply chains, to commodities exportation, all of those things when COVID locked the world down. I mean, to me, it's a supply shock almost like having a world war, because it is the same effect when you don't have people going across borders and you have people locked in their houses hiding effectively. So that type of supply shock is going to take a while. So when you combine the two, here we go. All eyes right now are on sort of when and where is peak inflation. So when is that sort of peak number going to be posted, at least in the US? I'm saying a lot of things US centric, understanding that there's a global audience in most cases. But so anyway, looking across the pond to Europe, I worry for them because of their disadvantages with energy and obtaining steady energy, specifically natural gas. I look over to Japan and I worry about the same thing. And you're starting to see some things you haven't seen in 15, 20 years, where the euro's at parity or the yen's about to touch 140. And, meanwhile, the Japanese central bank is sort of committed to yield curve control. And it seems like the currency market is sort of losing some faith there. So those to me are the really big events I worry about, a deep depression in Europe and the possibility for a currency, a top 3 currency like the yen to sort of blow up. The yen the Japan is a top 3 GDP in the world. So I worry a bit about those sorts of things. I do think inflation will cool because there's a variety of things, in my opinion, that make it quite a bit different than what we saw in the 70s where it got wildly out of control.
Okay, so I'm just showing this M2 monetary supply, which is like, the chart is insane.
Yeah.
And then obviously we talked about the euro to dollar. Yeah. It's just, it's highly favorable for those wanting to travel to Europe.
Right.
Not good timing for me last summer, kind of transferring a portion of my net worth into euros. So that was got a nice 20% haircut on that in FX swings. And then the yen obviously just being ugly. So let's talk about your views on inflation, because it seems to be, I mean, like you said, the year of inflation. All of the Bitcoin guys have been calling for this for a long time because of monetary policy, Right. But yeah, let's hear your views on it.
Yeah, so I think most people, and I would say I was probably pretty much in this camp too, and I'll tell you why I've drifted just a little bit from it, but most people sort of believed, especially post 08 crisis, where central banks went in and printed a bunch of money, that sort of immediate inflation it didn't, and it really didn't until what we're seeing the last year or so, maybe a year and a half now. But because sort of we didn't have the supply shock side to really put that immediate squeeze on prices upward. I tend to think that monetary supply definitely matters, but what matters more is how much money flows directly to the consumer. So sort of that credit expansion function. You can print a bunch of money, but if you also simultaneously make bank reserves a lot tighter, which is effectively what's happened over the last decade, then that money really doesn't go anywhere. And so it's out there, sort of the gross, it's almost like gross and net exposures for hedge funds. I mean, you can have massive gross exposures, but if your net exposure doesn't change, then, it's not a directional portfolio that you have in your hedge fund. So I think of sort of inflation as that kind of that net number. The credit expansion has to go to the consumer in order for that inflation to really kick in hard, in my opinion. So that's where I think it was more of the fault of the fiscal side of things over the last year or two, which is government spending, versus the monetary side of things, which is controlling the money supply. So, but regardless of all of that, looking at King Dollar basically destroy everything, it reminds us of a couple things. One is liquidity rules everything over the short term, without a doubt. And so when people need liquidity, everything sort of gets cashed in. But two, the dollar's, had an unbelievable run against the other major currencies around the world. And then without I think we need to sit back and I'm a big fan of cryptos. I'm a big fan of gold. You still have to sit back and ask yourself why has gold not performed at all for a couple of years now? The Bitcoin one to me is a little easier to explain because, it's all about flow there. And if, once it gets going and some things unwind, it's going to get hurt. On gold though, it is interesting to me that central banks don't seem to be piling up a ton, and they don't seem to be leaving the US dollar despite everything that the US government has done to be irresponsible. So I kind of step back and I say my observations from that are that the US is still the best shirt in the closet on the monetary side, and the world still believes in it. And sometimes I laugh at how at the moment, but because if you're a country where your currency's depreciated 10 or 15%, and oh, by the way, oil's gone up 70% in the last year, and it's priced in dollars, I mean, that is just constricting. So probably the third leg of what I worry about or start to look at is, you see little signs of unrest in places like Sri Lanka, and people will put up with a lot of things, but when it comes to food, that's when people really will lose their minds, and you can't blame them. So that's kind of where we could see some unrest, and possibly unrest in what we think of as pretty civilized areas of the world. So I worry about that. So that's kind of the concern,
Feels like a powder keg always, like when talking about these things, right? Like growing wealth inequality, and then food scarcity, energy concerns, like these things start touching on a lot of the road towards pitchforks and torches, as I say often on this. But let's dig into gold a little bit, because this is kind of an interesting one, right? Like flight to quality, global inflation, everything, like the fiat monetary system looking like a little fragile in places, yet gold is just kind of stubbornly sitting along. Talk to me about gold.
Yeah, I mean, I kind of grasp at everything when gold hasn't moved. A couple years ago, I was watching and participating some in cryptos rising. Not enough. I wish I had more at the time. But, I wondered if maybe gold was picking up some of the incremental flows from Bitcoin. I mean, because at the end of the day, there's some use for gold, but a lot of it to me is money flow, and where's the bid. And so I feel like that's a real possibility, but it certainly hasn't caught any of the outflow in Bitcoin at all, and has had a bad year so far. I still think gold is enduring. I think honestly, we can't underestimate the power though of the fiat system that's sort of developing to what it is. When you look back and you kind of laugh, because we were backed by gold, then we were loosely backed by gold, then it was like, well, there's no gold anymore behind any of it. And when you have enough decades where that's the case and nothing like literally explodes, I mean, go talk to people on the street and ask them if they care if there's gold backing their dollar or not. And so I don't think there's not sort of this retail panic away from the dollar. And I think that's maybe what it would take to push gold way higher. And so if there's one thing that the US Federal Reserve has done well, is I guess when they needed to. They've proved that the dollar is still the number one currency. Because I mean, no one is paying. I mean, that's the one thing I can, even if you talk about clients and working with clients, which I do on a daily basis. I do remind them here in the U.S., which I couldn't if I were a European based advisor with European based clients, that the dollar's winning right now. And so it's a little bit easier for me. It is an element of what we talk about that makes it a bit easier because the dollar looks good.
Yeah, no, it certainly does. I mean, it's king dollar. Let's talk about like things that keep you up at night. I mean, for me, like sovereign debt is just
Yeah.
insane. The levels globally, it's kind of tough to like continue kicking the can down the road when it hits the
Mhm.
sovereign level. But yeah, would be interested kind of what things kind of out there keep you up at night and
Yeah.
worry you for your four small children, right? And the life that they're going to
Yeah.
live.
Well, I do worry about all those things. I think macro countries that have natural resources will be okay. Fiat currencies and a lot of what we talk about are just sort of a unit of account for all of that. So if there was some large reset, you just kind of reset to what those natural resources are. So from a personal standpoint, I like owning, some land, and I'd like to have some more real estate. I obviously love to have, public securities too. But what worries me in general, I've thought this for a long time, is a sort of reset on the currency side, because it's so devastating when people think about, you know, if you think about people fleeing out of risk assets into an asset that carries sort of this unknowable risk itself, then that is really concerning, because people, to me, the default right now when I talk to a client is the most risk-free position is going to cash. I mean, that's it. But when cash is a problem, what do you do with that? So to me, I do think a canary is if and when gold substantially starts dominating all currencies. To me, it's almost more concerning than, being happy if I happen to be in that heavily with clients at the time in 10 years, or if and when that happens. But to me, that would be a sign of fiat, struggling. I worry about what I see in Japan, because I do think, as a country that, like you said, they're probably the worst in terms of debt to GDP. They're trying to control their yield curve, effectively keeping their debt servicing costs lower. But at the same time, the yen is slipping. To me, that says what you're doing is not working and it's going to break. I worry about that one quite a bit. If that happens, I think it's over the short term, except for the global financial risk and financial side, but for the US dollar, it's fine. I mean, a lot of money will flow to the US dollar and effectively strengthen it. But then the question is, what if that starts to happen in the US eventually? And then that's sort of the death knell there. Right now, we're still strongly in this game of alternatives, in my opinion, or choices. You go from one or the other. It's a relative game. So if the whole game stops, then that's the problem. So that's what I worry about the worst. Over the relative time period, I don't worry too much about it. And then I kind of step back and, I'm playing things out well beyond. I mean, this is the truth. Sleeping at night, thinking about things you probably shouldn't. It's got to getting too crazy there. But, if you really play it all out, then you kind of go back to the fact that in the US, massive landmass, top 3 or 4 landmass. So those are the types of things you have to think about. If you're an individual living in a very small country with very little domestic natural resources, it does mean that you're more of a derivative, or a smaller, you're more reliant on a lot more things from other places, and your country will not be able to look inwardly for everything it needs to maintain the same standard of living if there's a massive reset. I think those countries, or countries that aggregate together properly, which Europe very well can do, will be okay, but they'll have to, navigate the change of all that. So.
Yeah, no, I think, and
That
this is
makes
the thing
sense.
is like, no, it does make sense. And this is the thing is like, you go down these dark kind of paths, but in reality, if there's going to be a great reset sort of thing, everything fails. Everything is like going to
Yeah.
zero basically. And it is a pitchforks and torches sort of
Yeah.
situation. So you have to just make the assumption that the game keeps on playing and
Right.
kind of
Yes.
figuring out how to position accordingly. So on the position accordingly, you talked a bit about real estate. What other kind of assets would you like in these sorts of markets, or assuming that's kind of the way that we're going?
Yeah, I think as a base safe asset, in a way, we're probably the best hedge to currency. What the government does with currencies is real estate. I mean, and probably, and when I say real estate, let me define. Actually, it's a great thing. One, obviously, it's great to own a home. Just for most people, it's a good deal to do, and primarily not necessarily because you'll make a killing on it, but one, you're really saving yourself some rent money that you'd be otherwise paying somebody else. It's kind of a good just cash flow tool to break even over time and your housing. But outside of that, on the pure investment side, I do like I like raw land. I think it's good. Now, it doesn't cash flow very well, hardly, even if you put ag on it. In my experience, ag is also a tough game. So you can't think of it as a cash flowing crop, but I do think you can solidly think of it as going to keep up with whatever happens to inflation and currency and not be devalued. I do not. So that's a good one. I think the cryptos can be good, but from that standpoint, really just Bitcoin to be a bit of a maxi or whatever. But I from a pure inflation or a value hedge, would be that one. But it's going to be massively affected by inflows and outflows, so way more so than land, but obviously more liquid, so that's good. Other parts of real estate, I like commercial real estate. I would just think about real estate and where you own, in my opinion, on 10-year basis of forces about population trends. To me, it's pretty simple. If people are moving to an area over the long term, your prices are going to be stabilized, period. Because if you're in commercial, in pretty much any sector of commercial, if one industry that's dominant in that area goes down, well, again, you got that flow of people coming in, which means new businesses, which means new industries popping up. So in the US, I think there's pretty big trend right now. I mean, the simple move of New York to Miami. It seems like New York, not as favorable on owning New York commercial real estate as I would be of Miami, because I feel like there's just sort of this demographic. I mean, I don't feel like it's happening. There's a demographic uplift there. So it kind of feels like you're not going to go wrong in that type of area. So cash flowing commercial real estate is good. It's hard to own direct. I mean, you're going to have to have big numbers, especially in the bigger metros. It's a little bit easier. I live in the middle of the country a bit more, so price points are a little lower here. But otherwise, you have to look at some sort of LP vehicle in all likelihood. I'm not a fan of publicly traded REITs. I mean, look at this year, for example. Most people have direct ownership in real estate or are pretty much flat or maybe even a little bit up on the year in their real estate. And even with the slowing in home mortgage lending and the increased cost there, I expect housing to hang in pretty well just because it's been pretty undersupplied over the last 10 years. But publicly traded REITs are down as much as equities. So public REITs, to me, while they can make money at times, are not they're in the public equity bucket, in my opinion. So there are some traded REITs from some of the big real estate, investment companies. So you could look at a Blackstone or a Starwood and just look up non-public REITs and kind of take a look at some of the research there. And those are about as close as you can get for a small bite size of something that's not a public common equity of a REIT and should perform more like direct ownership in a individual building.
Yeah, no, and that's good stuff. I mean, so the theory with real estate is protect against devaluation, prepare for inflationary times. But I'd be curious, because I mean, seriously, for 2 years on this thing, it's like rubbing it in my face that I don't own enough real estate. But everybody's beating the real estate drum.
Yeah.
You, with your financial market knowledge, kind of more broadly speaking, what situation happens within broader financial markets that real estate actually significantly underperforms or does poorly?
Yep. I think that's a great question. That's a great question. So I would say I almost always divide it into two camps, because who are the players in that market? What is the market construct? So you've got home and residential. So I'll just start with that really quickly. To me, home and residential is all driven off of where mortgage rates are. And so when mortgage rates were down 2 or 3% for a 30-year fixed, massive inflow of money there, just made it so easy for people to buy. But now we've got the double whammy of home ownership costs on the interest rate side have doubled or close to it. The benchmark 30-year for conforming is about 5.7%, and it was around 3% just a year ago. So that's going to slow things. And additionally, the price increases over the past couple of years haven't quite come off yet. And so right now, today is a tough time for the new, smaller end home buyer. So therefore prices will cool somewhat, in my opinion. I don't know that they'll crash. And the main reason I don't think the residential housing market will massively crash is because I think much of the leverage created, in fact, the numbers back this, much of the leverage created over the past few years has been fixed rate leverage. And why not? When you can get 3 or 2.5% 30-year fixed, most people didn't say, I'll try to save 0.25% and get the 5/1 resetting, the ARM product, as we call them, adjustable rate mortgage. So I think that we're going to see sort of more homeowner strength, even if prices decline. They've got their payment fixed, so they don't have to bail in their home. And I've also seen lenders just so much more stricter. So I think that the money has not gotten quite as profligate in residential as it could have been. On commercial side, I think what would make areas of a crash, and I was really concerned about this, was something like a office, space just really getting crushed. What I see in a lot of commercial has been a lot of sort of redesign of certain structures. And so I'm seeing, for example, buildings that might have gotten sold at a loss by somebody that were all Class A office in downtown, top 5 metro or something. And instead, now they're going to put retail on the bottom. They're going to put office in the middle or 2/3, and then they're going to put some downtown housing in the top part. So some of those trends, I think, are being mitigated by that. I mean, ultimately, a large crash in real estate is going to be triggered by the need for liquidity. I mean, it's just always how it is. And so rates moving up where they have on the commercial side, I don't think is going to cause that inherently. We have to remember, obviously, tons of, commercial debt is sold away through CMBS, non-agency CMBS for the most part. And there could have been a massive event in that 2 years ago. I mean, there really almost was, but I haven't seen that occur. So I would say, if there's a bad refinancing cycle where sort of the big lending money, gets really negative on a certain area, that could start the trigger. I mean, other than that, I think some of it's just overpriced a little bit here. Cap rates got just way too low. And so I guess the simplest and purest answer is if the 10-year treasury went to 6%, for example, all real estate would have a substantial reset. So, yeah, but outside, if rates hang in, I think we'll be okay.
Yeah. And I mean, it's important to note that real estate is kind of not even a real thing, right? Because the real estate market in your town versus LA Beach versus some other place, these are all very, very different. And then thinking globally,
yes,
perhaps the mountain towns in Bulgaria are a screaming deal right now.
Yeah. No, you're right. You said it right. If there's riots in the streets of your city, I mean, that's going to be a tougher place to sell your real estate.
Exactly. Good luck with your commercial building. Nobody's buying lattes when there's riots, I mean,
it's a great point, Ben.
Yeah. Well, on that, I was looking through the show notes from our last talk, and we talked a bit on markets.
Mm-hmm.
So I know we've probably got about 10 more minutes, but let's talk briefly about emerging markets, given the talk about the dollar strength and kind of where you sit with emerging markets.
If I were going to say what asset class, given our environment, has underperformed the most relative to what you would have thought, in my view, or at least the most difficult area to manage, it would have been bonds. Anything bonds. I mean, even the safest of bonds, moved down 2 or 3%, and just the duration move was just massive. You can't underrate what happened in bond markets. If I said what may have outperformed the most versus everything else going on, it could be emerging markets. Because in emerging markets, you've got a large slug of China, you've got some Russia, you've got this group of countries that has absolutely struggled from a currency standpoint, but yet the MSCI emerging markets through June was actually ahead of the S&P. I mean, in terms of the loss by about 3%. So kind of a shocker there. I like emerging markets long-term. Probably the country I'm most interested in within emerging markets is India, possibly Brazil in there. If I just think about large landmass countries, so lots of favorable, demographics and things in their favor. But India possibly will surpass China in population here pretty soon if they haven't already. It's hard to say from numbers you look at, but I think that's a really interesting one. In portfolio construction, I typically, as a U.S. investor, I'm going to be predominantly U.S. and really have been, especially lately, very, very heavy U.S. centric. But instead of going toward developed ex-US countries like Europe, Japan, Australia. No disservice to them, but they're probably similar to us, and I think we have some advantages. So to get some real diversification, I typically barbell my allocation with EM, which is absolutely the riskier part of ex-US equities. So I like emerging markets. They're still strongly tied to the dollar in many cases because they issue a lot of their debt in US dollar. And so, I always have some concerns or some worries about some of their currencies because on a micro scale, you see those things play out. Argentina blew up just a few years back. And that example of, as a US investor, you own an Argentina bond, and in about 2 weeks, their currency had come off by 25% at least, probably cruising toward 50%. And those bonds start pricing in default at maybe, and so they're trading at 50 cents on the dollar. That's the type of sort of multiplier to the downside you can experience if you're in the wrong emerging market country. But I think that we will probably see in our lifetime, whether it's China, and China very much has, but maybe even another China-like emergence, because my main thesis for why that could occur and occur rapidly, more rapidly than we've seen in the past, is I think about it, one of the wonders of life, and I'm digressing a little bit here, is when a child is born, it's basically a full reset, right? And so everything we have to teach them, like over the whole scale of humanity, is a lot. But our information transfer and ability to share information is so much greater. I mean, I just think about all the kids from these different countries around the world that can go back to their country and just stay in tune with what's going on in the US or other countries that are a little more organized. That can happen. And I think it will happen at a little faster rate. So I'm very positive on emerging markets.
Yeah, happen potentially at a very much faster rate. I mean, I think of like Raw Paul with the exponential age, and everything's moving so much more quickly because of the interconnectedness. And yeah, it's very interesting. Also, what you said about India. Have you read Balaji's new book, The Network State, by any chance?
No.
Very good. I'll link it in the show notes. Really, really good. But he's super, super bullish on Indians, like the Indian people, and less so on the Indian government. He's like, if the government could get its shit together, like India would just be crushing it. But you have some headwinds there. I'd be curious what kind of contrarian opinions do you have, or things that the common narrative that exists that you disagree with? Looking for hot takes here, and obviously none of these are like financial advice or opinions of your Wells Fargo. They're your own, that whole disclaimer. But yeah, lay it on me.
Well, I mean, one hot take I stole, I'll just say, which is funny, is, I'm not funny, but one hot take would be to say Russia is almost better off than they were before they entered Ukraine, despite all the financial sanctions. I'm sure you've heard that one before, and you kind of think about it, it's kind of interesting. So,
which is crazy.
Crazy. Probably contrarian, and this may not be a super hot take. I think tech comes back. Especially the larger tech companies, a lot of the froth does not. I don't think you're going to see a Rivian trade at 100 billion market cap for a long time, but will Facebook and some of the other FANG stocks, possibly lead us out here? And that's on the back of maybe a bit of a hot take here, because I'm not quite as depressed about, inflation and where we're headed as the market seems to be when you look at all these confidence numbers. I do think we bend here, and maybe we trade sideways, and it may take us a couple of years to claw back toward all-time highs, but I don't think we're going to go below 3,000, barring the big events I talked to you about, where I think if Japan or Europe really blew up or something like that, then that could take us there. But you're just looking at the orderly market we've pretty much had, I think we could just be sideways to higher from here for a little while.
Yeah. And just last question is on the Europe, or either the euro or the yen blowing up. What kind of canaries in the coal mine, or what kind of cracks in the system are you monitoring that you would be watching for the average listener to kind of protect or think about these existential risks to all markets?
Yeah. Well, I think the basic sort of groundwork for the game, if you will, or the, being in financial markets, is watching the dollar and how it reacts to various commodities. I think a canary could be something like the yen blowing out. I mean, if you see 170 or 200 on the yen, that's going to have some ramifications. And it doesn't necessarily mean the S&P 500 goes down or whatnot, but it means that things are changing in fiat world. So that's really what I'm looking for. What are the signs that things are changing in the fiat world? Another one is how much US dollar denominated debt is being issued around the world. That's a large reason why the US dollar has such a vice grip on things. So watch sort of that ratio. And then also, to me, watching the trend of sort of isolationism and those sorts of things. If every country kind of looks inward, then there's a very real chance that everything costs more and we have less of it, because trade allows people to use their natural strengths to sort of make each other's lives better. That's part of sort of the contract. So I don't know if that helps exactly. I don't have one indicator to look at. I don't.
There's a lot of interconnected, all of these things.
Yeah.
It's tough to look at one particular thing. I think that deglobalization and kind of the ramifications of that is really, really interesting. And I mean, all of this, it's like a big, crazy experiment in real time.
Yeah.
So we'll
Yeah,
see
it is.
how
It's
it
fun.
goes. But Peter, always appreciate having you on,
No problem.
man. You can speak through all of these different asset classes, which I very much appreciate.
I appreciate
Where
it.
can my listeners find out more about you? What would you like to leave them with?
Sure. Yeah. Just everybody, I think stick to your long-term game plans. Definitely keep your cash and liquidity levels at a good pace here, and be safe. And yeah, I feel free to connect with me on LinkedIn, and wish everybody the best.
Awesome. And I'll link those. Peter, great to see you. Thank you so much.
Sounds good. Thanks, Ben. Appreciate you.
Good to see you.
Good to see you.
There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.